Hi there, my name is Nhyira Premium and welcome to my series on the financial accounting standards on the business lecturer in within show. Now in this series of accounting standards, I'll be taking you through various accounting standards that you need to know in financial reporting, in corporate reporting, so that you can prepare adequately for the examination. If you don't know, let me inform you, or if you know also, let me remind you that financial reporting is going to have a 20-mark question on accounting standards, and corporate reporting is going to have a 25-mark question on accounting standards. Now, everything as well in financial reporting, with the exception of a few things, is actually going to be based on accounting standards. So your ability to be able to understand the fundamentals of each of the accounting standards will increase your chances of passing the exams and position you in a better way to comfortably write the exams. Now, in this video, I want to talk to you about one of the new accounting standards that came into effect last year, that is January 2018, and as such we expect the examiner in May 2019 to set some questions around this accounting standard, and this is Ifrs 15, revenue from contract with customers. Now this accounting standard is actually replacing some accounting standards such as IAS 18, revenue, and then IAS 11, construction contracts. Now the limitation on IAS 18 revenue was that it had a problem with recognition of revenue, and profits were always overstated, and profits or revenue for one period was given to another period. For instance, if I am a business and my year ended is 31st December and I receive a contract from somebody, so I'm a business, so someone comes and say that, Nhyira, I want you to teach me from 2019. So let's say we are in 2018, or we were in 2018, and the person said I should teach him in 2019, but because of booking purposes and the person wouldn't want to be on the waiting list, so the person decides to make payment upfront. So the person makes payment on 20th December and my year ended is 31st December. Now under IAS 18 we would have recognized that as a revenue, but you agree that recognizing that as a revenue for 2018, the work will actually be done in 2019. So when you recognize the revenue for 2018, even though when the work will actually be done in 2019, meaning that you'll be overstating the profit for 2018 and understating certainly the profit for 2019. So it was this limitation of recognizing revenue before the actual work is undertaken, and overstating of profit in one period and understating of profit in another period, that caused the International Accounting Standard Board to issue this accounting standard to replace and really illustrate how revenue should be recognized as and when the company undertakes the activity that the revenue is expected to be paid for. And I believe that this is the accounting standard that actually solved that problem, because under this accounting standard we are going to recognize revenue using what we call the 5-step framework. In other words, before we can recognize the revenue as an entity, we need to go through these 5 steps that are behind me on the board, and I'm going to run through them with you, and then I'll take them one after the other and talk about them. So before we recognize revenue under IFRS 15, revenue from contract with customers, the first thing we need to do is to identify the contract with the customer. So that's the first thing, identify the contract with the customer. The second thing is identify the performance obligation. Now when we talk about performance obligation is simply the activities, goods or services that the entity is going to transfer to the client or to the customer under the contract, and I'll come back to that in a moment. Then determine the transaction price. The transaction price has to do with how much money the entity or how much consideration the entity is receiving, excluding payments made to what? Third parties. And I'll come back to that also in a moment. And then the fourth thing, which is going to be the area that we are going to be spending much time on, is the calculation area. And this is where we allocate the transaction price to the performance obligation using the standalone prices of each performance obligation. Now don't worry, we're going to go through all of these one after the other. Then the last one is that we recognize revenue as and when the entity satisfies a performance obligation under the contract. So these are the 5-step framework, meaning that before we can recognize the revenue now, these 5 stages has to be gone through. So let's look at the first one. Identify the contract with customers. IFRS 15 states that before we can recognize any revenue, before we can even think about recognizing revenue, the first thing is we need to identify a contract with a customer. Now, when we say identify the contract with a customer, what does that mean? So, for instance, if you come to me that, Nhyira, I want you to teach me financial reporting for the next 2 months, yes, teach me financial reporting for the next 2 months. Is that a contract? Or what is it? Is it a contract? Is just a promise? What is it about? So the standard gives conditions that must be satisfied before we say that there is a contract with a customer. In other words, for us to say we have a contract with a customer, 1, both parties must approve of the contract. That is the first condition. Both parties must approve of the contract. What does that mean? If you say, Nhyira, I want you to teach me for the next 2 months financial reporting, I should say yes, meaning that yes, there is going to be a contract between us. So that is the first recognition criteria. Both parties must approve the contract. Second, the terms of the contract should be known or should be agreed upon by both parties. In other words, each party must know their rights to the contract. So I must know what really I'm going to be doing in teaching you financial reporting for the next 2 months. You should know what you are going to be doing. So everybody must know their responsibilities, their rights and obligations under the contract. That is the second recognition requirement for a contract with a customer. The third thing is that the payment terms must be agreed and communicated. Very important. Now, I'm going to come back to that in a moment, but let me talk about the fourth thing, which is commercial value. Now, there should be a commercial value. In other words, the agreement or the contract, the approval of both parties must result into some transfer of consideration from the customer to the entity. So if you come to me and say that, Nhyira, I want you to teach me financial reporting in the next 2 months at your free time, then I cannot recognize that as a contract. Why? Because that contract does not have any commercial value. Are you getting it? That contract does not have any commercial value. So if we know the commercial value of the contract, then we can now agree on the terms of the contract. Then the last thing is that it is probable that the entity will receive the consideration. It is probable that the entity will receive the consideration from the contracts. Very important. So if you come to me and say that, Nhyira, I want you to teach me in the next 2 months and I'm going to pay you $1,000, I need to sit down to find out whether you will be able to pay me with that amount of money that you are telling me. So when these 5 conditions are present, then we will say that yes, there is a contract with a customer. That is the first thing. That is the first stage of recognition of revenue under IFRS 15. Do we have a contract with a customer? We find out from these 5 things. If these 5 things are present, boom, that is good. We have a contract with a customer. So I'll see you in the next video as we go through the rest of the stages on recognition of revenue.